current accounts, let's now dig into the capital account that we also sometimes call the financial account in Europe. This is strictly the same. As an initial reminder, to make things very clear, your capital account records how the current account is financed. So it can also be seen as the total difference between the total sales of domestic assets to foreigners and the total purchase of foreign assets by domestic agents. Okay. So, all the financial inflows will be recorded as with the credits because an inflow, so some funds coming from abroad, is a way to finance the domestic economy, meaning that a foreign agent is acquiring, buying a domestic asset and providing as a counterpart an equivalent lump of money that the domestic country will benefit from. And the opposite is true. A financial outflow when a domestic agent is purchasing a foreign asset, so leading to some domestic resource being transferred abroad. You are buying a foreign debt asset. In the meantime, you transfer a domestic lump of money to the foreign country. So this, of course, will be a debit because it's a domestic fund, but you won't be available anymore for its own domestic use. All right. The same way as the current account, we will just explore briefly the main sub-accounts that you will find. And you will see the same way from the least liquid to the more liquid. So the least liquid source of funding being the foreign direct investment. If it is the least liquid, it is also the most reliable, long-term investment. When someone is doing what we call a foreign direct investment, an FDI, it statistically means that it's purchasing more than 10% of a firm equity. And if you purchase more than 10%, you likely want to have a long-term claim on a specific foreign entity that you are interested by their management and you want to extract long-term added value. It's slightly different from what we call a portfolio investment, which is just, you do not care about the kind of asset you purchase. What you want is just to optimize your risk return investment. So portfolio investment is typically any debt security, as I said, a bond or a bill, or some equity if you purchase less than 10% of the firm capital. Third, you have what we call the official international reserve. So this is basically the role of central bank, as we will discuss this afternoon, that will, if any exchange rate targets will buy and sell foreign assets, again, to impact on the currency value, but also sometimes, to counter some financial instability. I will tell you that. Some other kind of assets, such as derivative instruments. I don't know if you have any idea of what is that, but no matter. And what you call the statistical discrepancy, you will see that the balance of payment is not an exact science, and we always end up with some errors, omissions, that we call statistical discrepancy. And you will see that sometimes to analyze the errors is meaningful, more meaningful sometimes than analyzing the official transaction. We'll see this is quite fascinating, what we call the black hole, le trou noir. Okay, so here you can see the full list of items in the capital account, again, from the least liquid to the more liquid item. And again, to wrap up, all the kind of, so this is both for the capital account and the current account. We do record the same way the credits plus and the debits minus. So all the inflows are resources of a country and they are credits. So everything which is listed on the green quadrants. So in the current account, the export, this is, you receive a payment for your exports. That's an inflow, a financial inflow. So this is a resource for your country, and this is a credit. The same for services, the same for transfer and remittances, the same for any dividend you perceive, and the same for any FDI that you welcome, so any foreign direct investment that your country is welcoming. This is an inflow, a source of funding, welcome. This is a credit. The same for the portfolio capital inflows and everything. If you can benefit from debt cancellation, you are lucky, and this is also a resource. Well, and then you have all the uses of those resources being outflows. So you did produce, you have some savings, and then you enjoy those extra savings to invest abroad. So these are outflows, or you use your funds to pay for imports, products that you did not do yourself, but that you will enjoy the consumption. So these are use of your funds, import of goods, services, interest payment if you went into a debt, short-term capital outflows, and a decrease in the central bank reserve. All that is a use of resources, and outflows being recorded as a debit in your balance of payments, both in the current account and in the capital account. Well, so the capital account, as you understood, if we accept the FDI, that are non-debt creating inflows, all capital flows, all capital inflows actually reflect a change in the country asset ownership. So this means that your domestic asset will change hands towards a foreign agent. So as such, of course, the capital account reflects your international market access, whether or not you are fully integrated in the international market and international investors can easily get access. And as you know, if ever the country cannot honor some of its debts, some of its obligation, it may be excluded from market access for a while, and then become unable to finance any future current account deficit, for instance, or any future public debt. So this is the idea. So again, capital account is capacity to finance the current account. And if the country is losing access from international markets because we cannot inspire any trust anymore to investors, you understand that it becomes banned, excluded from this kind of funding. So what do you focus on as an analyst? You shall focus on the volume of financing, which is the size of your finance, of your capital account surplus. So the volume, and does it match or not with your current account deficit? So here I shall be a bit more precise. I'm sorry for that. You should look at what you call the balance of official settlements, which is your capital account without considering, any change in the reserve managed by the central bank. Because actually, what you want to know is, without having to pull on the reserve, can the capital account spontaneously finance the total amount of the current account deficit? The balance of payment is balanced by definition, but sometimes it's balanced only thanks to the central bank action pulling on the reserve, but also depleting the reserve. Okay, so what is interesting to look at is whether the balance of official settlement, as we say, is spontaneously balanced. So capital account, excluding the reserve account, is it or not filling the gap with the current account deficit? as soon as you have looked at the volume, you will look at the nature of the financing sources, being private, being public. As we discussed yesterday, this is not necessarily the same in terms of reliability of the funding. And then the sustainability of the funding, short-term versus long-term, any currency mismatch, legal clauses, repayment conditions, is the country authorized to repurchase its own debt before the maturity, for instance. What we call, I forgot, sorry, debt repayment, something like that. I will tell you. Well, so let's now briefly look at the main sources of stress. First, of course, we may first try to see whether it is not coming from an increase in international interest rates. What do we call international interest rate? One of them being, for instance, the US LIBOR. The US LIBOR interbank rate offered. So this is a typical benchmark. So mainly the one in London and the one in US, the US dollar LIBOR. And when we see that the US 6-month LIBOR is shooting up, it's a spike from time to time, well, here you may easily draw a conclusion that the country debt servicing is on a slippery slope. Another way to look at any stress on global balance of payment is, of course, to look at the IMF total credit outstanding. So this provides a global view on the international financial stability. Each time that the total amount of credit is spiking, as you can see here, it always revealing some global instability, and the most fragile countries are likely at stake and jeopardized. Just for you to know, for intellectual curiosity, as you can see here, the face of all the chairmen of the fund are all Europeans. Here, of course, you may recognize the French one, but two French ones, I shall say, Strauss-Kahn and Christine Lagarde. The new one, Kristalina Georgieva, who is from Bulgaria. And so this is not an hazard. This is an unofficial agreement that the US are providing chairman and the World Bank, whereas the Europeans are providing chairman for IMF. So this is the first custom. All right, so sometimes the country can benefit from what we call exceptional funding, when the capital accounts do not spontaneously finance the current accounts. And if the country is also running out of reserve, then phone call to the World Bank and the IMF for an emergency financing. So you have what will be IMF SDR, special drawing rights. We will see that in a short while, but it's not of high importance. The World Bank HIPC initiative is a highly indebted poor country. So this is debt relief for some countries listing some specific criteria. They must have a GDP per capita lower threshold, but I forgot which is rather low, but poor countries, and debt and solvency ratios extremely poor. So they must be highly indebted and poor countries, as simple as that. What we call the club debt reduction. So this is again an open request of debt countries. If truly they have issues, they should be analyzed, and the London Club may propose some remedies of different nature. So it's hard to go through all of them just now, but sometimes it's just a right mix of time. They provide more time to pay the debt and obligations also some fresh money being granted to solve this just, this is just liquidity travel. Time and money is most of the time enough to solve the issue. When it comes to a solvency issue, here it's more problematic. We need to think about restructuring or pure debt reduction, the debt haircut. But then it's not enough to say haircut. We also need to decide who will take the loss, who will endorse the loss. Because private managers maybe have many kinds. You have international banks having a specific regulation that can, for instance, have a specific regulation for debt loss absorption. Maybe for instance, tax deductible, so they have incentives to grant debt relief. The regulator is granting some advantage for the banks to accept to renegotiate their debt. And by contrast, they have investments on conventional asset managers, for instance, which is the same. Here about the Replication Act, they don't have a structure that is set up to withstand extremely long negotiations, so they may incline to go through long and tedious litigation. But by contrast, they also have what we call vulture funds, or hold-out funds, which use to step in the negotiation process, block everything. They just refuse to renounce to any claim, and then we go through expense and protracted litigation with the country, and sometimes when they get legal actions, especially to extract any assets. So that would end up the nature of the creator. So this is just for official creators and usually governments. This is usually smoother negotiation, even for instance, Trump is not inclined to accept any debt relief. Well, I'm moving now to something extremely interesting, but this is about the so-called errors and inflation. And if you remember, I said that sometimes it is more meaningful as official balance management records. Well, of course, here we need to we need to understand where those errors and omissions are coming from, and how come that we record those errors and omissions in the capital accounts and not in the current accounts. Well, first you have some reasons being technical reasons. You have always inconsistencies in the time of recording, for instance, between the corresponding debit and credit. We need and lag between the trade flow and the payment flow. Let me be more concrete. You export products, for instance, in November 2019. So this will be recorded as a debit in your current as a credit, as an export, as a credit in your current account. But then when you receive the payments, likely in international transaction, it will lag several months afterwards. So you may receive the payment only in January or February, and this may be recorded in the next year balance of payment. So this is typically the kind of time and inconsistency between the trade and the settlement. Well, we also have some data collection issues because it's very hard to track any transactions. So we make use of sample surveys, and here for statistical authorities, there's always a trade-off between the accuracy and the timeliness. We need to provide aggregated data on due time because many analysts are relying on it. But the counterpart is that if we want to rush to produce a nice statistical table, we also need to renounce to a perfectly exhaustive tracking of all the capital, all the trade and movement. Okay, so these are technical. The third one I would say is human. And human is that there's always a tendency to under-invoice the export and to over-invoice the import for tax optimization, of course. So this is, you will see in the next graph, when we compare the export over-invoicing and the import under-invoicing, in average, it's a 5% difference, which is not worrying. Beyond 5% of difference between the total value of export and total value of import, this is becoming more worrying. Well, the fourth reason, and this time is much more problematic, but also more meaningful to some extent, is the undeclared short-term capital movement. To make it in plain English, this is what we call capital flights. So you are hiding the fact that you are putting some funds aside and you try to put them in a fiscal paradise or in any foreign bank account. So you don't trust anymore in your domestic economy, you don't trust in your domestic banking system, and you prefer to withdraw your funds and to try to park them somewhere else. You find it safer. So this is the undeclared short-term capital movement, also said capital flight. So we will explore that and how it could be interpreted. So first, as I said before, the global difference between the imports being over-invoiced and the exports being under-invoiced, the green bar. So as you see, most of the time, the difference is minor, between 1 to 5%, and this does not raise any issue. When you can see in 2004, 2015, 2016, this starts to be a signal, an alarming signal, because here the difference is slipping much above 5%. Here is a gap between export and invoice, export and import invoice, total amount of invoicing. And looking at Russia, we can clearly see from 1994 to 2014 a clear increase in the negative net errors and omissions that you can see here, the red bars. So here, not only the size, but also the variation do matter. So this was clearly revealing what we call the capital flight, that has been assessed on the right table with the private deposits of Russian citizens, all in international banks. You can see, so these are data from the Bank of International Settlement, who succeed to track, a cross-country bank claim, and international bank did report to the BIS that they have high amounts of Russian deposits in their accounts. And if we were looking at the balance of payments in the capital account, we would also grasp the intuition from the errors and omission that the sharp increase in negative figures here was, of course, suggesting that many companies or households are escaping, flying away from the country and parking their funds abroad. This is bad. This is bad, of course, for the balance of payment and the capital account funding. These are domestic resources that won't be available anymore for the country. And when you start observing this kind of sharp increase in capital flight, you also raise huge concern, not only because the balance of payments might not be finance anymore, but much more, this is always a self-revealing fact. The attitude of a household, what we call, it's Wall Street versus Main Street. So the household are the main street, and That's you and me in the streets, and we do feel that something is going wrongly in the country. And this is quite often an early signal, because at the end of the day, we can read as many reports as we wish from the IMF. This is good to be read, but ex post. It is not always revealing some early warnings, signals. But local companies, local households always have, a second sense of what is going on in the country. Is there any chance of political turmoil or coup d'etat or corruption or an adverse business climate? And all that is systematically leading to capital flights. People do not trust anymore in the economic capacity, and they prefer to save their fund abroad. So this was clearly the same thing in China. As you can see, a much higher capital flight was clearly visible from 2014. On top graph. So this was due to maybe if some of you are feeling more at ease in economics, and sorry for the others, and it's not a big issue if you do not get this idea, but this is what we call the usual Mundell-Fleming dilemma. When you have a slowing economy, that were the case in China, also because world exports were slowing down, the only option in terms of policy mix is what we call the monetary stimulus. So is to request central banks to stimulate the economy. And one way to do that is to what we call the credit easing or quantitative easing. So either to massively purchase assets to increase money injection, or to massively increase credits in the economy. So this is of course lowering domestic interest rate, and also usually leading to a currency depreciation, because low interest rate generate lower attractiveness of domestic asset for foreigners. And then the depreciation is often going along with capital outflows. Capital outflows because, again, investors who brought their capital are fearing the devaluation. So if they suspect the devaluation or the depreciations to go on, they likely prefer to repatriate the capital as soon as they can, as fast as they can, leading to capital outflows. And this, in such a case, the authorities have not much maneuvering room, except, for instance, imposing some capital control or capital restriction, saying that you are not allowed anymore to flow your capital whenever you want. Of course, this is hard to fight. For instance, undeclared capital movement. There's always, unfortunately, ways to lead capital flights, whatever the capital restriction that the government may impose, even in China. And it's funny to see in the bottom graph here the big difference between what is the official data, the official statement from Chinese authorities, from the SAF, SAF being the state authority for foreign exchange, which clearly reveals that the exchange rate is monitored, and you can see the difference between the blue bar and what we call the unusual cross-border flows in Chinese renminbi, and this is again a way to approximate capital flights. What is not officially recognized by the Chinese authorities, because this is, of course, as we say in French, un aveu de faiblesse. All right, I hope so far so good. I understand that there's many information in the meantime. We just have a few last things, and then, of course, the lunch break, and we will start this afternoon with a small WOOC Lab question to review all what we said about the balance of payment. So from what we saw yesterday on growth imbalances, and this morning on the current account and the capital account. So just to finish with this morning, I may need 10 minutes more. And first discuss, that's very interesting, you will see. I mean, what did we say? We said, let's analyze the balance of payments and notably the capital account to spot whether or not the country will run out of funding. But you may question the following. At the end of the day, why do we care? And how any stress on the balance of payments will result in an economic crisis, a banking crisis, or any other kind of crisis? Well, as I said also, you may remember, the balance of payment is only recording flows. The question is how the stress on the balance of payments in the flows may result in changes in stocks on the debt and on any banking system asset and on the country reserve. We'll start with the impact on debt. So this is extremely interesting, and I hope that you are still focused despite the lunchtime. How do you think that an exchange rate movement of, let's say, 10% depreciation of the US dollar will impact on the US net foreign wealth? So again, here we look at in terms of stock, the total amount of US foreign liabilities, total external debt of the US, to make it simple, versus the total amount of US foreign assets. As you know, hopefully for the US, many economic agents are owning foreign assets. And then we look at the spread, so the difference between the total foreign liabilities and the total foreign assets owned by the US, and we see what is the difference. You can see that sometimes the spread is quite narrow, or sometimes it's widening, as it was the case in 2007. So now we will try to lead the analysis. So first, looking at the graph, what do we see? We can see that the value of foreign assets held by US economic agents, the blue line, is clearly growing since the 1980s. And this is a good sign. Of course, this is good, meaning that the US accumulates foreign assets. But we cannot stay at that stage. We shall also compare with the liabilities, the all debt that is the US owe to the rest of the world. Here we see that the total foreign liabilities are also growing, and actually has grown faster than the foreign asset. Well, so again, we will look at the spread between both. Foreign assets owned by the US were an amount of, so in 2008, roughly 1.2 or 1.3% of the US GDP, and the total gross foreign liabilities were accounted for 1.6% of the total liabilities. Well, is it the end of the story? It's not really. Why? In which currency do you think the total US liabilities are denominated? So I think this is quite intuitive. The US debt is denominated only in dollar. Why? Because any foreign investor is willing to buy US debt in dollar. They're happy to get some dollar. Dollar is usable for any international transaction. So this is why the US have this exorbitant privilege, as de Gaulle used to say, to have 100% of its debt, external debt, denominated in dollar. Good news. Again, shall we close the analysis? Not really. Because is it the case also of the foreign assets owned by the US economic agent? Here, the rule of thumb is that normally when you purchase a foreign asset, the foreign asset will be denominated in the local currency in which where you purchase the asset. Here again, the US has a small privilege because they succeed to purchase foreign assets even in dollar. So this is also good news for them, but not all of them. We estimate that roughly 70% of foreign assets owned by US agents are denominated in foreign currencies. Okay. Now that we know all that, can we figure out how a 10% depreciation of a dollar will impact on the US net foreign wealth or net investment position, which is again the spread in value between the total foreign liabilities and the total foreign assets. So, do you think that a 10% depreciation will impact on the value of the US liabilities? So this is self-evident, since they are fully dollar denominated, whatever the value of dollar, it does not impact. Okay. So the dollar could depreciate as much as it wants. It will not impact on the US foreign debt, US foreign liability. By contrast, this will impact on the 70% of foreign assets owned by US agents denominated in foreign currency. Do you think that this will impact positively or negatively? If the dollar depreciates by 10%, it means that the foreign currency in which foreign assets are denominated will appreciate by contrast. So this is a good news. This is a good news. If the dollar depreciates, this means that the value of foreign assets being owned by US actors do increase. By how much? So let's use any your calculator and do the following. Foreign assets in 2009 did represent, let's say, 1.3% of the US GDP. 1.3% times 0.1, 10% depreciation of the US dollar, times 0.7, 70% of assets denominated in foreign currency, for which the depreciation will have an impact. So if you do briefly the calculation, which this is equal, so 10% times 70% times 1.3% of the US GDP is equal to 9%. So what does it mean? It means that a 10% depreciation of dollar will lead to, in this case, an improvement, an equivalent amount of 9% of the US GDP. And as there's no impact on the liabilities, it's another whole 9% relative to US GDP improvement of the US net external wealth. So that's absolutely huge. Just as a way of comparison, the US current account deficit is usually around, in average, 3% or 4 or 5%. But 9% is more than at least 2 years of US current account deficit. So here you understand that all the interest of US is to keep the US dollar as low as they can. The same as China. So there's no surprise that they do conflict on their trade and on what we call the currency war. So again, they have all interests, since a 10% depreciation of dollar would wipe out the equivalent of 1 or 2 years of a trade deficit in terms of their net, in terms of stock, of their net external debt liabilities compared to their foreign assets. So just briefly shall we blame China as Trump keeps on doing? Well, frankly speaking, I don't want to be an opponent of Donald Trump because I'm not a candidate to the next November election in US, but the answer is not clear. I would even answer no. If you carefully look at the graph, so let's say this one, the right graph, you can clearly see that the US exhibited a negative current account much before China export share, which is the relative red bar compared to the total US trade deficit. So we clearly see that they had a deficit much before the share of China getting bigger in the total current account deficit. So actually, if you look at this graph, China got into the World Trade Organization only in 2001. And the current account deficit started much earlier. It started already in the 1990s with the NAFTA agreement, so the free trade agreement in North America. So it's clearly not an issue with China. What is true, nevertheless, is that clearly the total US deficit, as you can see here, went bigger proportionally to the higher share of Chinese exports in the US current account. So it increased proportionally to the higher the higher role of China in the export, but it did. I mean, it started to be negative much before Chinese export eruption, I would say. So again, if we look at the bilateral US deficit with China, it got stabilized around 45%. And what is quite noteworthy is that it tends to reduce. So here, since 2016, and even actually before Trump statements and trade war, they slightly reduced. But again, this is on the, as we say in French, sur le trait de plume. This is an extremely small adjustment. This is still a big dependency on the US deficit on China exports. So what could be interesting is, of course, the 2019 Sino-US trade agreement. You may know that China got committed to buy more US goods. But if we look at the figures that I did yesterday, for the first quarter of 2020, China bought actually less than a quarter of the targeted full year amount of US goods that they agreed upon in the deal. So you see in Trump's face that it will likely not be happy, and we may think that the Chinese authorities may bet on the fact that they will get rid of Trump by the end of the year with the November election. But up to date, it's very clear that the trade agreement they made last year will not reach the targets. So to explain the US current account deficit, it's maybe more meaningful to investigate the US trade balance components. So here you see the biggest US imports components. So they mainly import computers and capital goods, telecom equipment and electronic device, automobiles also. And looking at the exports, they mainly export aircraft with Boeing, medical equipment, refined petroleum, as you know, with a shale gas, agricultural commodities, and that's the main soybean main exports from US. And they export also a lot of financial services. All right. I think we run out of time because we already slightly exceed the time frame. So I may suggest to stop here for this morning.